Mm.
Hello, everybody. Welcome to our webinar entitled Lift as We Climb. I'm Michael Lear, board member at the Impact Capital Forum, and in my day job, I'm a senior vice president and private wealth advisor at Capital Group here in New York. I'm joining you from my home office and hope to be getting out and seeing you in person in the very near future. And I want to thank you for joining us. Before I get started, I want to give you a little background on the Impact Capital Forum. The Impact Capital Forum was founded in 2003 and was previously named the Microfinance Club of New York. Since that time, we've expanded our scope to address all aspects of financial capital, human capital, technology, and natural resources that benefit the world through the lens of financial services. ICF now has over 3,500 individuals in our network. Most members are professionals with a background in financial services, financial inclusion, and fintech. However, our membership is open to anyone who supports the club's mission. We host approximately 25 or more events a year on a wide range of topics relevant to impact investing and social enterprise. And in the coming weeks, we'll be hosting a conversation entitled A Day in the Life, where we will have the opportunity to talk to someone actively working in the impact area and exploring what that work actually looks like on a day-to-day basis. So if you enjoyed today's discussion, and I'm sure you will, I encourage you to consider membership. It's relatively inexpensive and a great way to support our community. And with that, I'd like to get into the theme of today, which is lifting as we climb. And I can't find two better people to speak about this than Bahiyah Robinson, the founder of Include Ventures, and Ed Duggar, the CEO of ReInventure. Bahiyah and Ed, how are you?
Good morning, or good afternoon, as the case may be.
Good morning for me in San Francisco. Good afternoon for you.
Yes.
Yeah. So why don't we hop right into it, and I'll start out with Bahiyah. Can you talk to us a little bit for our audience? What is Include Ventures? What is VCInclude, and how did you come up with the idea for this enterprise back in 2018?
Oh, thanks, Mike. And again, great to see you, Ed. I'm looking forward as well to reconnecting offline and in person. And thank you for everyone for being interested in the conversation. It's funny, you mentioned social entrepreneurship. I was a social entrepreneur, as they called it, in the late 1990s and early 2000s when I was, a few years old. But the nomenclature has shifted so much. By the 2000s was really around being a social entrepreneur, supporting social entrepreneurs, and also just finding my way as kind of a professional, trying to figure out how to kind of build a career around doing well and doing good. And so about 2010, I started focusing on this new thing called impact investing. And about 2009 or so was when the Global Impact Investment Network was started. So I was kind of part of that movement out of or through this social entrepreneurship lens into this kind of thing that almost became is becoming an asset class called impact investing. And I would argue now is kind of morphing into ESG, but it's all about, how do you derive and drive value in new market opportunities around technology, around innovation, around environmental change, climate change, and those things. And as most of you well know, that was really called kind of concessionary, right? So the traditional investors, institutional investors, looked at impact investing as philanthropy, right? There was it's just another word for philanthropy. We're not investing in it. It's not long-term. It's do-gooders doing stuff over there, right? And so over time, we realized that we have to make investments into great businesses that also have a double or triple bottom line, right? Social, environmental, et cetera. And so it's been really exciting to be part of that movement and that drive. I worked as a senior consultant at Ashoka, building public-private partnerships in the about 2010 or so, and then started investing in the first generation of tech entrepreneurs across sub-Saharan Africa with the World Bank and State Department. So that really allowed me to think through what it really takes to drive and build an enabling environment for innovation, impact, and investment, because there was, large continent. How do you connect? How do you build that infrastructure? And so learning that with a lot of public and private sector partners, starting the first tech hub on the continent, one of the first 6, the first tech conference, Demo Africa on the continent, and really working with the leaders in the tech space, the Microsofts, the Amazons, Googles, et cetera, as they were coming into market, looking at Africa as a new market opportunity and how to harness it. I came back to New York in 2014 and realized a lot of that enabling environment work that we were doing in Africa actually needed to be done right here at home. An African-American born in California, raised in New York City. And so when I saw that this fantastic city called New York City was technologically enabled, but there were no women or people of color that were in that tech innovation ecosystem, whether at the company level or at the investment level, what's wrong with this picture? Why aren't we building this enabling environment here at home? And so I really switched a bit to focus mostly on the US. 2 or 3 years later, after raising a few $1 million for some Black women founders, I realized that it was really about looking at the supply chain of capital and actually at the asset manager level, where was their diversity? Where were their women? Where were their new majority, Black and brown and indigenous managers, investing in those opportunities that they see on the ground. And that's where I got really excited and launched VCInclude, because in 2018, before pandemic, before COVID, there was this idea that that you couldn't aggregate best in class fund managers that happen to be women and new majority managers. And so I thought, no, I know, a lot of them. So let's test that, right? As a social entrepreneur, let's see. And so 3 months later, I had 15 funds, 18 months later, I had a pipeline of 200, working with almost 30 funds, met Ed somewhere around, we're trying to figure out when we actually met, but at some point we met. And for me, it was exciting because again, we did two things. We validated that, that diverse teams outperform the market, which we have a lot of data on now, but I was actually able to see that. And we were able to start to build a pipeline of asset allocators that were, either interested in or becoming interested in diversifying their portfolios with more new majority managers. And so I'll pause there, but that's kind of how things started to take off. And now we have, training education arm, asset management arm, as well as an advisory firm, all focused on that focus. Oh, you're on mute.
Mute.
2 years, you figure I'd be better at this. Anyway, so thanks for that background, that additional color. And Ed, do you share with us a little bit about your journey?
Yes, Mike. Again, thanks for inviting me to be here this afternoon or this morning and to share this with you. But my background it ties interestingly into what Bahiyah said, because I have been involved with what we now call impact investing for about 30 years. The funds that I managed were funds that were certainly designed to generate a return comparable to any venture fund, but at the same time address the conventional wisdom, quote unquote, that perhaps founders of color couldn't build scalable businesses, or perhaps they couldn't do it profitably. And perhaps put whatever bias in there you want. And so the funds which I managed were intended to create at least a data point that said, that is not true. And so the last fund I managed prior to ReInventure, my most recent, was one that actually moved founders of color. We invested exclusively in founders of color. First of all, let me start by saying, we generated an internal rate of return of 32% over a 10-year period, investing exclusively in founders of color. And I love to say that because it is like, what? But we did it by investing in founders in 10 different sectors on the cutting edge of our economy: software, medical instruments, environmental services, broadcasting, et cetera. We did it by building, much from scratch, some of the largest, most successful Afro-American controlled businesses in the country, both public and private. We did it by providing our capital as the footings with our other capital partners of financing of over $2 billion for their growth. We were way ahead of our time in terms of insisting that they be inclusive in terms of their business practices, and set a goal of having at least 30% of the management teams and the employees of color. And we hit that across the board. And we, in the process, generated some 7,000 family supporting jobs. And so even though we didn't call it impact investing at the time, we called it making a profit while making a difference. We are sort of the early pathfinders, if you will, in terms of this whole effort that's so much more robust today.
Mike, if I could just double click on that, because I know, we are talking to a very broad audience. One of the things that has driven me to create the Include franchise is I know 100 or more Ed Duggars, right? I mean, I don't know. Ed Duggar is his own. Let me not say it that way. Actually, Ed Duggar is that's okay. Of itself. But what I'm saying is that type of story with the, returns profiles, with the, backgrounds, there are the ideas where are there? There are hundreds of managers that, have that same similar profile, focused on different industries, focused on different regions, et cetera. But it's so exciting for me to envision a future where, ReInventures, right? ReInventure is fully capitalized and in Fund 3 and on Fund 4. And, equally, there's more managers like ReInventure and funds like ReInventure that are able to scale, right? Because they have the access to capital to make those types of investments. So I get very excited when I hear a story, because I'm like, this is why, right? This is the why.
Well, I frame this conversation as obstacles and opportunities. So since we started down this path, what have been, and I'll let you start, Bahiyah, what have been some of the obstacles to scale? Because as you say, hundreds of these folks, they're doing great work. And why haven't we seen more of the fruits of that labor?
I mean, I'll speak to the positive thing. I think, unfortunately and fortunately, COVID and the pandemic and kind of at least the initial slowdown, I don't feel like we're in a slowdown anymore, but initially the slowdown of like, wait, what are we actually doing here? What are capital markets doing? Where are we? How are businesses, companies, and communities being impacted, right? Just using that word, not as impact investing, but kind of thinking through that connection. I think COVID and the pandemic and even George Floyd and other things, that cauldron of things coming together within that first 6 months, created this new movement. And at least I call it phase 1 of a move to say, we do need to invest better, right? We do need to look at the opportunity set better. And I think that within that, understanding and realization, as we could, corporations and banks and financial institutions, investment firms started to kind of call me and other folks and say, hey, how can we, we want to, right, invest in more new majority managers and do better job at doing things like thinking differently. So one of the challenges about due diligence, thinking differently about track record, not being so stringent in terms of having to have attribution from another firm or these kind of rigid, boxes to check around investing in kind of Fund 1 or Fund 2 managers that might not have those types of robust track records as an institutional fund on a traditional platform would have. And so we have seen, again, asset allocators start to look at the way that they do due diligence, the way that they measure track record a bit differently than they did in the past, which has opened, the door for investment into what they used to call emerging managers, Fund 1s, Fund 2s, new managers that even though they might have, again, an investment background, this is their first fund or institutional fund, concept fund, whatever the case may be. Ed, did you want to answer?
Yeah, one of someone who has been raising capital and gone through the process most recently, one of the things that we had to overcome in this impact space was how folks thought about impact. In other words, when we think about ESG, for instance, there's the environmental, there's the governance. There's not so much the social as it has to do with equity in the allocation of risk capital. And so as we, sort of made our pitches, et cetera, it was really trying to get folks to understand that there was more to impact than the environmental, sustainable, et cetera, and that there were some real issues that could be dealt with near term in terms of economic inequities that were very important fundamentally and actually tied to all those other things as well. And so our fundraising effort became easier, sadly, with the death of George Floyd, when suddenly the pendulum swung and brought a national reckoning around this issue that, there is something we need to focus on as investors. And it seemed like we were right in the right position because that's exactly what we had been arguing for sort of all along. And so, and that was profound in a number of ways. We had a number of investors that they became investors by seeking us out on their own through our website to figure out how they could align their personal values with their investing, and that's been very gratifying that we have individuals that wanted to do that beyond the institutions.
And so as we think about kind of the opportunities, is I hate to say it, is this moment an opportunity to think about, how we scale up and where are you finding these areas of capital in terms of the LPs that you're looking for?
I could jump in for a second. I mean, look, one of the things that, a couple dirty secrets here. One is that there's plenty of dry powder and there's plenty for everyone. There's plenty of capital in the markets to invest in, new market opportunities. We know that as well. And I think I mentioned it before, diverse teams, diverse founders, they outperform, right? And so we've got tons of data. All the major banks have really dug into this just to make sure that, what we say is correct. And we've got the data and metrics to back it up. And so now, the question is the market going to continue to and increase allocation, to, historically underrepresented managers and companies that are really driving alpha. They're driving market rates of returns. I would argue that, we look in the next 5 to 10 years, VC specifically 2.0, the ones that are going to win are the ones that, double down now on underrepresented founders and managers. I mean, we're seeing it. I'm here in the Valley. I'm here in San Francisco Bay Area, and I'm already seeing that kind of internal realization. People are a little bit hesitant because it's not pattern matching the VC 1.0, right? But they're I had a conversation yesterday, which is we're seeing all these fantastic, Black and brown and women, folks that are coming out, and we want to hire them because they're so fantastic. And there's thousands of them, right? And so there is a movement, I believe, that's building. And look, if you want to make money, you're going to invest in the best. So.
What I would add to that is that, we often talk about what we do is the bad news and the good news. The bad news is that this inequity in the allocation of risk capital is pervasive, is deep-seated, et cetera. But the good news is that it also provides us an opportunity to make investments at good pricing with substantial growth potential that others have simply overlooked for reasons I really cannot understand. But they have. And so, we have a unique opportunity to demonstrate that when you think about the investing we do, put it in conventional terms, we are a contrarian investor. The herd of venture capital firms are going after an elite group of founders who are principally white males and have effectively narrowed their view, narrow the opportunities that they're looking for. We have said our focus is founders of color and women, and you take that as a percentage of the population, and that's a pretty big percentage. So the opportunity for us is huge, particularly when you're dealing with a segment that represents the fastest growing segment of our entrepreneurial community and the ones likely to add the most value to our economy moving forward. And so we think we're very excited about what we're doing as Bahiyah is. I mean, because we see the opportunity there and, invite many others to join us.
And so with that, what do you think is going to accelerate this process? Is it people's recognition that they need to invest in these areas and that there are opportunities to make money? Or is there something else? Is there accumulation of Black wealth that allows you to have LPs that look like the folks that you see on the screen? Like, what changes the narrative and where we've been to where we'd like to be?
Do you want to take that, Bahiyah? Okay. Well, I think what happens is, there's a certain dissonance that occurs when you're talking to allocators about what we do, for instance. That dissonance is, have I just been sort of impartial, or have I been discriminatory in the way in which I've approached this? Have I been complicit in creating this inequity to begin with? If I continue to do it the old way, will I be complicit? And so there's that dissonance that people have to get over to say, look, regardless of what I may have done in the past or my investment practices, there's an opportunity now to do it differently, and to do it differently for a whole range of reasons. It can be on one end for the social impact, on the other for returns. It doesn't matter. You'll get both.
Yeah, I would add, I totally agree with that. We have engaged hundreds of LPs on behalf of the franchise, whether it's through, our first-time fund manager programs on the training and education side, whether it's through our platforms, Fund 1, Fund 2, and 3 managers that have track records, or even when it's, through our own due diligence for our fund of funds, that's doubling down on the best of the best. I think the tension is, as Ed Duggar said, I would label it as this unconscious bias that, we've heard, shared around. It's tough, right? To look at yourself in the mirror and say, am I doing that? And then you have to go through your own kind of private Idaho of, well, is this true or not? And am I really, and so that's tough, right? That's tough self-assessment and self-awareness. But I do think that, and I see, the market rates of return all speak for themselves, right? So for folks, to Ed's point on the kind of impact, social, environmental, et cetera, impact, that are still scratching their heads, how much of this is, me just being a fiduciary, right? That word is thrown around a lot, is my fiduciary duty. But, the fact is, you're not really upholding your fiduciary duty if you're not investing in these new, funds and companies that are driving, they're driving returns and they're driving alpha and they're outperforming the market, at least in the private capital markets. And so, I think that tension is, it's bumping up against itself, because as much bias as there is, it's like you either kind of, I'm trying to think of a nice analogy, but I think you have to lean into it. And I see that on the allocator side. I see folks coming back, some of them that said, well, we're only focused on market rates of return, so we're going to come back to you in 2 or 3 years when, you're the managers that are fund ones, finish that round and look at fund 2. Okay, that's fine. But then I see them coming back earlier, right? A year later, 8 months later, 9 months later, and saying, our board has now mandated that we change the investment policy statement, the IPS. And, now it's, the whole, firm is around at least increasing our, our platform of managers, and diversity at least 5%, because it's like 0.02. The numbers are so low that when they start looking, actually, again, doing that self-assessment, they're like, why don't we have a number of managers that represent the population, right? And that includes women. I like to, it's about racial diversity, but it's also about gender diversity. And I try to make sure that I make that point every time, because I'm, that intersection of both. And I think sometimes we forget that it's not just about racial, but also gender. 1.3% of asset managers managing 70 trillion of assets under management in the US are women and people of color combined. And so that number just is not reflective of the opportunity set that we see and that we know is here. But again, the first movers are going to be the biggest winners. So we're excited to be part of the first movers.
One of the things I might add, Mike, is that, in order to do this investing, you have to look at things differently. And so what does that mean? For us, for instance, when we look at an investment opportunity, in contrast to our peers, our traditional venture peers, who might look at a founder and say, well, they look at for success in the traditional ways. You went to this school, you had part of this network, et cetera, et cetera. And so they give value to that. They look at a founder of color and they start looking at failures. And so and that is a handicap to them, because when we look at a founder and look at the obstacles they've confronted and overcome and have gone perhaps a more circuitous path, but have continued to demonstrate the persistence, the this and the that that's required for success, we give those obstacles they've overcome a value. And we say, we add that to the checklist of things that's important to us. And as a result, our vision of who is worthy of an investment changes. We can see differently that they have overcome obstacles in a way that will make them great entrepreneurs as opposed to ultimate failures.
I think that's a good point about the risk assessment, right? Because again, they throw around asset allocators, throw around fiduciary duty, right? That's one. And I know I'm toggling between some of your questions, but the other one that they throw out is risk mitigation. And so, what Ed was, elucidating is that there's inherent resiliency in, our experiences, and, certain communities, immigrant communities are one that's very well regarded, and, immigrant, yes, but same thing is true for, again, women and historically underrepresented groups in a lot of these investment teams. And so I'm not saying that that's a blanket statement that every historically underrepresented group is going to succeed, but it does create a profile, from a risk mitigation perspective of resilience, of being able to kind of get up and not eat in the morning, but go and get that that degree, let me just back up and say, what I'm thinking about is so we had a fellowship program through VCInclude last year, and we had 258 applications of first-time funds. Now, this was the first, fellowship ever that was focused on BIPOC, Black and Latinx Indigenous managers. And so when we launched it, we didn't know, folks asked me, well, how many applications are you going to get? I said, it could be 50, it could be 500. We don't know, right? So we got 258, 115 of those fit this kind of VC and impact profile. So again, great number. And then we started to collect data and have an internal report around that. And it's never been published, but I'll just tell you, most of the outperforming funds and the folks that applied, they had an undergraduate degree, over 50% from an HBCU, plus an Ivy League graduate degree, right? And so this is data that, you wonder, who are these folks? They've gone to, traditional, they have non-traditional backgrounds. They've, been able to kind of make it through to, Ivy League educations, et cetera, work at some of the top investment firms as analysts and as, investors, and they're coming out on their own and say, we know how to do this. We have a subject matter industry expertise, and, we want the shot to double down on folks that we see that are in the market and that we think that can outperform. And so just giving you kind of numbers and data around, what we're seeing holistically in, the US and beyond.
Right. One other thing I would add quickly, Mike, is that we shouldn't think of founders of color as simply young people. Most of the founders that I've invested in the past and ReInventure, they're between 35 and 50. They have had corporate careers of 10 or 15 years before hitting whatever glass ceiling they did, either because they wanted to or not. but have now found an opportunity to take that experience and create a venture of their own. And so, that opens up a whole additional pool, if you will, of potential founders for us.
Well, I want to pause there for a second because we got a great question in the chat that kind of flows well with what we've been speaking about. And I'll paraphrase a bit here. There's a gentleman on the chat who's an impact and ESG institutional broker who sees a lot of allocators focus on teams having a long track record of working together as a requirement. And they're asking you, how do you recommend positioning teams that don't have a long track record? What are some of the effective ways to demonstrate that diverse teams outperform when trying to convince institutional decision makers? So I don't know whether Ed or Bahiyah wants to take that one first.
I'm going to let Bahiyah, you probably have more statistics or reference points. I would simply use my own.
Exactly. I was going to say, you have your more personal example, but I think, again, first time funds typically do not have a track record of investing together. There are a few exceptions. And what I think about is, and again, this also can be a barrier, depends on the asset allocator, of an angel investing together, right? So again, because it's not institutional investing, because if a team, a quote unquote, GP's investment team, doesn't leave the exact same firm, right, to spin out and be able to attribute that track record, because sometimes you can't attribute your record of what you've invested in an institutional environment to a new fund or a new firm, then their quote unquote isn't a track record. I think, the thing to push on is, how do we start to, again, reorient the allocators and the trustees and the investment committees on the allocator side that take those factors into consideration. So you're looking at, less stringent institutional fund 3, fund 4, fund 5 criteria for fund 1 or fund 2. I mean, it doesn't match, right? And so I think pushing back on the logic of looking at track records of first-time funds, it's just like, and then you can also speak to, sometimes I pull out examples, I'm not going to give any names here, but XYZ, white guy that just up and starts a $250 million fund because they're the son of someone, right, of note, right? And you're wondering, well, this guy has no track record, right? And then, so how are they getting to these, large funds that everyone seems so interested in investing in? So I think it's less about the teams, because they're not lying, they've made some investments together, they've looked at investments. I think a couple of markers to look for is, if they don't have an angel investment track record together, or they haven't, again, kind of had that spin out, which is very few and far between. Have they been identifying, do they have an investment committee of themselves internal, and how are they actually looking at their investment process, and looking at deal memos, kind of looking at and kind of digging into, do they have a process to evaluate deals that's institutional quality? And I think those are markers that can speak to, the potential for, track record returns and et cetera. So those are some kind of ways that some of the allocators that have invested in first-time funds that we know of have looked at it. And I'll just do a quick plug for a kind of a movement called Due Diligence 2.0, which actually looks at that process of due diligence differently, so that we can, again, start to invest and stop saying the barrier is things like track record, because again, that's not really true. But for institutional platforms, it tends to be that checklist for later stage funds.
Yeah, I want to underscore what Bahiyah says, because again, this idea of looking at things differently and not relying so heavily on, the built-in biases that have guided us forever. In my own example, I told you what my track record was, and yet, because I pulled together a different management team, we were considered first a new fund, new management. I mean, all the sort of things that just check the wrong way, but they ignored the fact that I had a very successful track record, that to do impact investing in general, as Bahiyah has said, you have to bring together a new management team. If you bring together, if you don't do that, you're repeating the problems of before. I mean, I would find it difficult, frankly, to hire someone who had 10 or 15 years of traditional venture fund, because I would have to untrain them to do this work. So you have to bring not only skill set, commitment, understanding of this space in order to do the investing well.
I want to also double click on, it's interesting that, again, Goldman Sachs, Morgan Stanley, JPM, GS, they've all put together these long studies that have all the metrics. And so to question it, continue to question and continue to say, but they don't have a track record, it's like, what are you talking about? Here's all the data, right? And so again, I mean, there's going to be, winners and losers and folks that, weren't early adopters. And this isn't crypto, Bitcoin up and down and all around. I mean, I know people are making tons of money, based on that, but that's, more on the kind of gambling side. This is really way less risky than it seems, and that allocators seem to feel, which is kind of back to that unconscious bias piece, right? It's like, so why not? If you start to knock on that door, you're like, what else do you need to kind of show? So that's the frustrating part. And I try not to, to start to make that the biggest thing. Because we are making headway, and we are, I'm like, in 5-10 years, we're going to be, this is going to be a completely different conversation. But it's worth saying now, because this is recorded and we can say, go back to that.
Yeah, I have to say, in my previous roles as an allocator, it seems like anything that looks different is risk. So, and when you're faced with that, it's like, I said to Ed yesterday, if you want to do something, you'll find a reason. If you don't want to do something, you'll find an excuse.
Yeah.
And what I find is when managers that don't look like your quote unquote typical manager come in, the tenor of the question seems to change significantly.
Yeah.
So with that, why don't we move to the positive? One of the questions I posed to you coming into this is, what are you most excited about? And that could be a company, a fund, that could be just the whole fundraising process. Like, what are one or two things that get you really excited about the work that you're doing?
I'm excited about Ed. I'm excited about ReInventure. I'll just say that. I'm excited about our fund to funds, being launched, being seeded, and being one of the, the first, really one of the 2 Black women fund to fund owners in venture. And if you look at the ESG sleeve, the first, and, not being the only one in the future is exciting to me. The managers that we have, supported, that we're doubling down on, the best of the best, is exciting to me. The companies that they are supporting that we're also co-investing in, because we have such incredible deal flow, is exciting to me. But I'll turn it over to Ed in terms of, portfolio. We've looked a lot at and look forward to, continuing to work with him and invest in and with him and his firm. We're excited to, we're excited about what we're seeing in the market. We've got a large 30,000 foot view, and we're very excited about, like I said, the next 5 to 10 years and the type of returns we'll be able to drive.
And I'm excited about what we see in the way of founders and the types of deals they're doing. That because I've been at this for a while, I've seen a generation of founders come through, almost like a horde. And the quality of the opportunities have been escalating dramatically. And I did pretty good on the earlier funds, but I'm saying that when you think about it, a whole generation of college educated experience that is unknown in terms of the history of Black folks in particular has occurred. And these founders are bustling, they're engaged in tech-enabled opportunities almost exclusively from the ones that I see. And it's just really exciting to see what role they can play, if allowed to, in the development and furtherance of our economy, the innovative side of our economy. And I think that we need to recognize that that group is the fastest growing, in the future, most significant catalyst for economic growth in our country, period.
So I'm going to pause on that for a second and then let you guys know in the last 15 or so minutes, we want to open it up for Q&A. We've got a couple questions in, but I'd love to see more people chime in and make this more of an interactive discussion. But before we start taking questions, I have another one that I think is important. A lot of people say they want to help and want to be supportive. And from where you sit, how can we best support you both and the work that you're doing?
My suggestion to those who are allocators or those who are advisors to allocators are really to question everything that you have done in terms of the way you approach that process, to look deeply for the biases that are inherent into it, acknowledge where they are, and then design something differently with some help from others. Because, you know, more often than not, I bump into situations where people don't know what they don't know. And so they need some help in sort of rethinking, you know, investing 2.0 or 3.0 or whatever the case may be there, because we're in a new space with regard to, you know, how allocations can be made in the most prudent fiduciary way that is now different.
I was just putting a few references in the chat of our work. You know, we're pretty holistic in the way that we look at sourcing, supporting, selecting new majority managers and women-led, you know, firms for all the reasons that I shared. And so to kind of be holistic about our solution set, we've got our training and education side that's a nonprofit. It's VCInclude, VCInclude.com. And so there's a lot of information and kind of ways to get involved and support there. And then, you know, if it's more about, you know, we want to write a check, we want to invest in, you know, the best funds, and the best co-investments, Include Ventures, which is our asset management firm with a separate team of 7. Happy to talk to you about that. And then the third leg of the prong of the franchise is really our, you know, advisory side. So if we're, you know, we're sourcing, selecting for instance, climate funds through our climate justice initiative that's focused on BIPOC, actually European and US based, about 30% European, 70% US based funds, all led by new majority and women leaders it's focused on climate solutions, right? So investing in companies that are specifically in the ESG space. And so, you know, I think we're, you know, well positioned to be able to, you know, identify who's in the market, as well as, you know, start to, you know, develop solutions for different types of allocators, either looking for, you know, non-dilutive or, you know, impact kind of PRI, MRI investments, as well as kind of institutional market rate returns, you know, investments. So that's our holistic solution. And you know, my life's work, and excited to, you know, be here for decades to come and show the, you know, outrageous success. I mean, that's the exciting thing for me.
That's great. I want to switch gears just for a moment, just because a segment of our audience is kind of newer in their careers. And so what advice would you have for those looking to follow in your footsteps? You know, what would be your best learnings over the course of, you know, the years that you've been in this business? What would you impart to these folks that are looking to start out their journey?
Their journey toward what, Mike?
It could be to be in your spot, to be a GP, or to be somebody running a fund, or even running a company that believes in this idea of diversification of thought and allocation of capital.
this might seem a bit odd, but one of the things that I think is important, let me just start by saying, when you scrape away everything that I think I'm doing, I think what I'm doing, I believe very strongly that opportunity is a result of shared privilege. And shared privilege, when you think about venture capital, or this type of venture capital in the way we're doing it, I'm an aggregator of shared privilege in the form of capital. And my job is to sort of repackage that privilege and share it again in terms of the investments we make with all the goals that are associated with it. So one of the things that I found that have served me well is when I've engaged with folks that, understand that by sharing even a little bit of privilege, you can create some extraordinary opportunities. So I would look, if I were starting my career, I would look for folks that understand that, that's what they're doing. In other words, it's value-based. And that they come to it with a commitment to do the same. Take the privilege that they have acquired, however small it might be, share at least a little bit of it to create some opportunities for others, and you'll be aligned in terms of career and movement. So that would be my advice.
Broad. I have a lot of random thoughts running through my mind. In terms of advice, I'd say definitely get as much practical experience as you can, right? I think being a practitioner, meaning taking the internship or the job, right, in the area of expertise that you want to focus on, is important to kind of build that muscle for investment, whether you want to be a fund manager going forward or you want to be an asset allocator. There are, kind of hard and fast. Again, I shared with you the fellowship program where, 80% of all of the first-time funds that applied, actually 87% had, multiple degrees, right? One of the fellows, won't say their names, if you dug in, and you probably find out who they are, 2 women, have 5 MIT degrees between the 2 of them, right? These are not, slackers. These are not folks that, just woke up one morning and said, we're going to be a fund manager too, right? So they put in their time, they have subject matter expertise, and they've put in the work. And so I think that, in this kind of VC 2.0, we need to make sure that, quality and that experience is still important. It's not just you wake up and become a manager. This is not easy work. We laugh and we're excited about everything that's happening, but it's tough. It's long days. I probably work 80 hours a week, don't sit. It's recorded, so it's already out there. So, on a good week. And so, it's a lot. It's a grind, but I'm doing it because I love it and that it's fun and it's going to be highly rewarding. And so that commitment, that, getting that experience, being committed, being resilient. You're not going to just get the right thing or don't expect to get the right thing and the only thing the first time you try, is really important to keep in mind as you, build your career and build your own track record. And then keep these things in mind. I think, one of the reasons why we like to, Ed and I are constantly on different panels and discussions is, making sure that there is a record of a framework to how can we make it a little bit better for the next generation to make it a little bit better for the next generation. And so, if we have that future forward approach to building, the type of generating the type of alpha that makes it absolutely a no-brainer to continue investing. That's what you want to have an eye to as well. So I think those are kind of general suggestions. And, there's a lot of other pieces I was thinking about, some of the large Ivy League schools that, contact us constantly with, we've got so many alumni or so many new graduates or so many, current students that want to be impact investors, that want to, go into venture capital, that want to go into, impact investors actually, for one large Ivy League, I'll be doing a 3-part workshop, because their feedback is, over almost half of their new graduates want to be impact investors, which is really interesting, right? And so how does that Ivy League prepare and engage so that, the students feel like they're getting, value for all the capital and blood, sweat, and tears they've invested in that education, right? Like, how can they jump in? And so I think we are the future. I think we are paving the way, and that's a big responsibility. And the next generation needs to take that same approach to being prepared and experienced, and also kind of, building the next generation of great companies and firms.
Yeah, and I would say stick with, following your purpose, because we have a now principal who joined us, I don't know, a year and a half or so, but she found us through LinkedIn. And we, which was a sort of a common way of introducing, but she was so persistent. She was saying to us that, look, I've turned down other jobs. I've looked at them like this, and I've said, I just can't do this. I want to be in impact investing. I'm going to stick at it until I do.
Yeah.
And so we hired her as an intern.
Yeah.
When that expired, we said, well, we can't continue with you. She says, I don't care, I'm staying.
Yep.
And she, for the next 6 months, and then we got to a point where we could actually hire her.
Right. Same.
And so, but what Bahiyah says, people are looking for employment opportunities, careers that have purpose.
Yes.
And we offer that.
Absolutely. Same. Actually, our team of 8, 2 of our analysts, one was an intern from USC. The other one was really kind of an assistant. I'd known her family, African-American woman, was just like, I'll do anything, and she wasn't even in venture at all, but she has such great organizational skills, and she became so integral and such a, that we, when we actually, were able to have salaries, we offered her a full-time position. We offered the intern who had built all kind of models. And he, his dissertation was on, these are, the things that matter. And we did that juxtaposed to LinkedIn kind of formal, we're looking for analysts, we're looking for associate. We got 880 LinkedIn applications. And, the folks that were right on our doorstep that were doing all the hard work kind of stood out. We said we need to go into market because there's a lot of folks that are asking to come on the team, and we want to make sure that we're, being fair and democratic. But, at the end of the day, to Ed's point, it's like the folks that, there is a, going a little too far with the stuff. a little bit of that, just so, know when to pull back a little bit. But if you're kind and you're persistent and there's a cadence and a sequence, I think it does work to your benefit. And if it's not, again, with the first target, it could be the second, it could be the third or the fourth or the fifth, but it should be mission and values aligned at the end of the day. And that's how you retain talent. And that's how you build like a culture of a healthy culture, right?
Right. Well, I think we're winding down here. I think that's a great note to end on. So this note of persistence and make yourself indispensable to your employer and keep plugging away at it and get those degrees if you can. I think those are all great messages for those folks looking to follow you. I want to thank you so much for your time and your effort and energy in this space, and wish you both continued success. And haven't seen you face to face in a while, so I'd love to connect again soon. So.
Absolutely. Thank you, everyone. Thanks for having me. Appreciate it.
For everybody who was able to dial in and stuck around, I'd love to see you all become members. So you know where to find us. Thanks, everyone, and have a great day.
Thank you. Bye.